craziest thing about this market, the banks are back. So far this earnings season, the major banks, other than, say, Wells Fargo, have reported some spectacular quarters. Just yesterday morning, Bank of America delivered what CEO Brian Moynihan called the best quarter in the company's history. You know I'm a fan of this one. I'm also a customer, full disclosure. Bank of America has transformed itself into the nation's leading online bank. They have the best digital and mobile technology by far, and it's helping them rake in deposits and fees. In fact, the deposits grew by $75 billion, and half of that came from the consumer, who, by the way, we learned from Brian is feeling flush. It wasn't perfect, of course. Bank of America's net interest income was stagnant, which is what you'd expect with an inverted yield curve. But the company's starting to make real inroads in investment banking, too. Equity's great, plus at 10 times earnings, ridiculously cheap. I think it's a buy, but don't take it from me. Let's check in with Brian Moynihan, the chairman and CEO of Bank of America. Get a better sense of the quarter and where his company's headed. Mr. Moynihan, welcome back to Mad Money. Sure. Good to see you, Brian.
Good to see you, Jim.
Thank you so much. Have a seat. Brian,
Me.
I thought that this quarter was a breakout quarter, and you can criticize it or not, but I think that you have crossed a level where you are a technology company that is really fabulous at banking. Is that a fair statement?
It's absolutely a fair statement, because at the end of the day, we have really talented teammates, the computers that they operate and the technology operate, and then, frankly, buildings to keep it all dry so it works. And that's what we have. And those teammates use those computers to either build them so clients can work themselves or work with them to help serve clients. And, 7 million digital customers, 28 million mobile customers, the numbers are just roll in. And by the way, what we highlight in our earnings report is on the institutional side. You're seeing it in the Treasury services. It's all been automated, wires and stuff, but now the interface to the customer is much more automated.
But what I'm hearing is recurring revenue. So even though I mentioned this net interest margin, it hasn't meant anything. If the Fed cuts rates, we were supposed to sell banks. Right. So I'm wondering whether there isn't something different happening, which is that your streams of revenue are really building and your costs are going down, the efficiency.
Yeah, and that efficiency, again, is driven by the technology enablement of the consumer and the wealth management customer companies, and it's always more efficient to serve it that way. Yet you have to have great people when the face-to-face meeting comes up, when the need is there.
Right.
And so that 57% efficiency ratio, we ran at about 13 and 3 billion in expenses, 13.3 billion. That is 7 out of last 8 quarters. We run between 13.1 and 13.3. One was a little higher. Right. But in that time, we've invested thousands of relationship management people, $3 billion a year in technology. In that time period, probably 60, 70 brand new branches, retooled probably 1,000 branches. All that investment going in, at the same time, expenses flat. That's enabled by the technology.
Now, as a customer, and my wife does the bank in her house, people keep hearing, well, it's a millennial bank because they have it. But I think what's really distinguishing your app is that it's not a millennial bank. There's not enough millennials to make those numbers. Right. It's ease of banking, which I never thought would happen. So you're spending a lot of money making a design that does appeal to everybody.
And that's the key. And by the way, it works for general consumers, it works for wealthy consumers, it works for small companies, it works for big companies. And so you're right. With that many digital customers, everybody's using it. Now, does it cohort, on age a little bit younger? What I said yesterday in the earnings about millennials was more about, there's a debate about whether banks like us are appealing to millennials. Right. We open accounts at 3 times the population rate in our new sales. We have about twice the population rate of millennials in our customer base today. They have, $60, $70 billion of checking deposit, just the millennials, and then Gen Z add another chunk on top of that. It's already a huge customer base, and the 16 million customers who are digital-only millennials have $200 billion of investments and deposits and loans with us. It's already a big business. As a millennial-only bank, it would be one of the biggest banks in the country, probably the 5th or 6th largest bank.
Well, I think those people stay with you. People understand that's a sticky customer. Once you get them at that age, they stay. Now, one of the things that struck me is that we've got 2 economies. You can tell me otherwise, but the consumer is doing so well. But then I have all these industrial companies, and they're not doing that well. How do you explain that dichotomy?
Well, I think also you have to parse the companies which are in the global economy, which with China slowing down and Europe expecting to grow faster but didn't grow as much, and the United States going from 3% growth to maybe mid-2s. Mm-hmm. The core thing is the United States economy is growing. Right. Is it growing slower than it grew last year? Actually, not so far reportedly, but expected to slow down because the first quarter is basically equivalent to last year. And the consumer is driving that. The consumer spending at Bank of America for the first 6 months of the year was up 5.5% over last year. The year before, it was up 8.5% for the year before. So it went from about 5% to 8.5% to 5%. Well, guess what? Those 2 years, 2.5% growth economies. And that's what we feel. So if you're selling into China, it's 20% of your business and it's slowed down, that's hurting at the margin, but everything else is fine. And so even our small and mid-sized businesses, they feel good. They used to be this enthusiastic. Now they're this enthusiastic.
Okay.
But 3 years ago, they were this enthusiastic.
Is that little enthusiastic enough to be able to make it so that if Jay Powell's watching this conversation, he doesn't say, oh, boy, to cut rates might be silly?
I'll leave that to the experts.
That's up to him.
But the evidence doesn't show that the consumer has slowed down. Unemployment's tight. Wages are growing. The teammates that's worked for us that was in the lower part of the wage scale, 75,000 and under, for the last 10 years has received 6% per year in salary and wage increases per year.
That's
Not once a year, 6% per year, 3 times. To keep a talented customer teammate base, you have to pay that. That's what I hear my clients saying. So wages are growing, spending's growing. That's all good. Is it growing as fast as last year? No.
No,
is it growing? It's growing fine.
But their balance sheet is surprisingly good. You always read these articles that saying they're taking down more debt. I looked at the balance sheet that was, and you're really exemplary, but there's not a lot of bad loans being made.
No, we're running along at levels that have been very stable.
Right.
We had a little bit of recovery because we sold some loans, but it would have been 43 sort of pro forma basis points of charge-offs. Mm-hmm. I think we've been in the range from 41 to 43-ish for the last, 8, 10 quarters in a row. And you get a little blip here, something like in the oil and gas a couple of years ago, remember?
Right.
This happens,
right,
that happens. But at the end of the day, it comes right back. But the key is the credit card charge-offs, year-over-year stable for the whole industry pretty much, and us too. Those are things that you show the consumer has borrowing capacity left, has used their borrowing capacity wisely, and will continue, I think, to do so because they continue to make money and pay off their debts.
Brian, I've known you for a long time, and one thing I think that we agree is that capitalism is pretty good, but it's been under assault. Senator Elizabeth Warren just this afternoon demonizing banks again. I want to give you a chance just to talk about some of the things that are important to you, about what you do for workers, because it's pretty monumental.
Yeah, if you think about our company, one of our basic principles is to be the best place for a person to work. And so we have, that goes across all dimensions, our diversity, our pay for performance, our reskilling, our leadership development programs, our opportunity for all the people. Our average compensation is about $140,000, $150,000 per person.
That's a lot.
And behind that, there's families. And so our health care benefits, and we insure about 400,000 people plus retirees on top of that, and the 401k and the match we have and all those things. But one of the things that's been interesting, and your colleagues were asking about earlier, is going beyond. So we have a thing called life event services. The floods hit someplace, we contact every employee. Do you need anything? What do you need? We'll help you. We do that in all the events that you think about. And so once I went, when the hurricanes last year were going on, I said to the teammate, how's the hurricane going? Think of the United States? He said, which one of the three are we working right now? Because we have people in, I think it was Singapore and Thailand at the time. So we do that. The life event service has been fascinating because along with mental wellness, the stress at work and can't cope question, which is something we've been working on in business at the American Heart Association CEO group with Alex Gorski and I lead it, but a whole bunch of CEOs thinking about this question. We've realized that mental health is key. So we run a lot of sessions about mental health, but the part of it was interesting was we got in this question about domestic violence. So we're a company has, a safe place to work, but even that, since we started, we have about 1,500 teammates that come forward and said they needed help with domestic violence. Not necessarily them. Sometimes a cousin, sometimes a child, sometimes themselves, sometimes a friend. And our job is to get in and help them and get them taken care of. And you think about a company like ours, if we have that many teammates, all companies have to be doing these kinds of things because, it's a company that makes good money, that invests in its teammates, that our work areas are safe. It's not, there's the stress in our work is maybe because we're type A people, but on the other hand, it's not unsafe, and yet you have this happen.
But what you're describing to me, we like to call it is impact per share. These people could work at a lot of different places. It's a tight labor market. Yeah. The things you're doing are to change people's lives.
Yeah, so we're $17 an hour starting, $35,000, anybody that starts in our company, going to $40,000 over the next 24 months. Plus you get full benefits. The effective rate of that $17 is about $29 an hour between the benefits and other things. And by the way, we're not alone. Other companies do this too, but that's what corporate America does, is we employ half the American population plus. We insure half the American population plus actually we employ 200 million people. And we provide these great benefits. And so the idea of capitalism, that's what capitalists do. They have to have great teammates to be successful. And we provide great benefits. And so the question for capitalism is we have to do both. Provide great returns, 16% return on equity for our shareholders this quarter, return on tangible common equity, and help society make progress. And that starts at home. And with our teammates, that starts on things like life event services.
Well, you're doing it, and the stock's a buy. I don't want to be so crass as to mention money, but it's a buy, and that does matter. That's Brian Moynihan, Chairman and CEO of Bank of America. You hear all the good things they're doing. It's the right thing to do. Mad Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.